Okay, so let's unpack this. It is Friday, January 30th, 2026. And, if you were to just casually glance at the S&P 500 or the Dow today, or even just check your newsfeed over coffee, you'd probably think everything is remarkably calm. The broader markets are steady, barely moving. It just looks like a sleepy end to the month.
On the surface, sure, it looks like a totally typical Friday. But if you peel back that curtain and look at one very specific, very vital corner of the market, there is absolute carnage happening right now.
Carnage feels like the right word,
Yeah.
based on the data I'm seeing. And it's so disorienting. I mean, we've all lived through the last 15 years of Mark Andreessen's famous mantra, right? Software is...
Software is eating the world.
Exactly. It was the golden rule of investing. If you bought software, you won. It was just inevitable. But looking at this stack of reports on my desk, the script hasn't just flipped. It feels like it's being shredded.
It really has. The sources we're analyzing for this deep dive, and we're talking financial reports, sector analysis, trader commentary, they're describing the situation in pretty visceral terms. One analyst actually wrote that the sector that spent a decade eating the world is now turning to cannibalism.
That is a terrifying visual.
It is, but it kind of fits the price action we're seeing. We are talking about a sudden, really violent implosion in software as a service SaaS stocks. And the mission for us today is to figure out the why. Because here's the kicker, and this is the part that I kept rereading in the notes because it just didn't feel right. The companies that are crashing, they aren't failing. They're reporting good numbers.
That's the central mystery we need to solve.
Yeah.
Usually a stock crash is pretty simple, cause and effect. Company says, hey, we sold less widgets, or we lost a big customer and the stock goes down. That makes sense. That is not what is happening here. We're looking at total disconnect between the fundamentals.
The actual cash these companies generate.
And the sentiment, this sort of existential fear that's gripping the market.
It's the battle between math and story. And right now, on this Friday in January, the story is beating the math to a pulp.
So today we're going to dissect this paradox. We're going to look at the specific role artificial intelligence is playing in this panic, because that is the elephant in the room. And we're going to try to answer the trillion-dollar question. Is this the end of the software business model as we know it, or is it just a massive emotional overreaction?
That is exactly the right question to ask.
Okay, let's start with the damage report, just to set the stakes. Because if you aren't holding these specific stocks, you might not realize how bad it is. How deep is the bleeding, really?
It's severe. We're tracking the IGV, that's the iShares Expanded Tech Software Sector ETF. Think of it as the master basket for all the big software players. If you want exposure to software, you probably own some IGV. In the month of January alone, it is down 16%.
16% in 1 month. For a massive sector index, that's not a correction, that's a bear market in 4 weeks.
It is. And the velocity is increasing, which is what has traders so spooked. Just in the last 48 hours, so Thursday and today, Friday the 30th, it plunged 7%. A 7% move in a major index in 2 days is rare. It signals panic selling. And we aren't talking about, speculative penny stocks or unproven crypto plays here. We're talking about the plumbing of the global economy.
Right. And I'm looking at the list of victims. These are household names in the corporate world. Microsoft, Palantir, ServiceNow, SAP. These aren't companies you can just turn off. They run the Fortune 500.
Exactly. And the timing of it all provides the first real clue to our mystery. This acceleration, this massive 7% drop, happened immediately after Microsoft, ServiceNow, and SAP reported their earnings on Wednesday.
Okay, so let's dwell on that for a second. Microsoft, ServiceNow, SAP, they all reported on Wednesday. And I went through the earnings transcripts and the summaries. The reports were fine. Actually, looking at the growth numbers, they were better than fine.
They were objectively solid. That's what makes this so fascinating. Fundamentally, if you just look at the balance sheets, there is no obvious reason for a sell-off. Revenue is up, margins are healthy, and crucially, their guidance, what the CEOs are telling us to expect for the rest of 2026, remains strong. They are not predicting a collapse.
So the CEOs are staying there saying, business is great, we see clear skies ahead, we're making billions. And the market is responding by dumping the stock as if the building is on fire.
Precisely. If you were an algorithm trading solely on current financial data, just looking at the spreadsheets, you'd be buying. But the market isn't just a calculator. It's a voting machine based on psychology. And right now, the psychology is being dominated by a very specific narrative that just overrides the numbers.
It's the AI disruption narrative. But we've known about AI for years. I mean, ChatGPT came out years ago. Why the sudden panic now? Why this specific week in January 2026?
Because the narrative has morphed. For a long time, the story was, AI will make software companies more efficient. It was a tailwind. Now the fear is AI will break the enterprise software business model entirely. It has become a headwind.
Let's dig into that. Because on the surface, Microsoft owns a huge chunk of OpenAI.
Yeah.
Palantir is basically an AI data operating system. You'd think they would be the winners. So why is AI suddenly the villain for their stock prices?
It comes down to two very specific theories that are gaining traction among institutional investors. And these aren't just, Reddit theories anymore. These are appearing in Goldman and Morgan Stanley notes. The first one is the in-house replacement theory.
Okay, walk me through that. In-house replacement.
Right. Think about the value proposition of a company like ServiceNow or Salesforce. Why do companies pay them millions of dollars a year? It's not just for the code. It's because building that software yourself, customizing a CRM, building an HR portal is incredibly difficult, it's expensive, and it's slow. You need an army of engineers, you have technical debt, it takes years. So you rent the software because the moat to build it yourself is just too wide.
Right. It's the classic buy versus build decision. And buying has always been safer and cheaper. You outsource the headache.
Until now. The fear is that the new generation of AI coding agents, the tools that were released late last year and are gaining steam now, have lowered the barrier to building software so drastically that the moat is just evaporating. If an AI agent can write, debug, and deploy a custom internal tool in a weekend, why would you pay ServiceNow a fortune every year?
That's a massive shift in leverage.
Right.
So you're saying a CIO might look at their budget and say, you know what, let's just have our internal AI build a bespoke tool that does exactly what we need for a fraction of the subscription cost.
That's the existential threat. If the friction of building software goes to zero, the pricing tower of the software giants just collapses. They can't charge a premium for something that is suddenly easy to replicate. It turns software from a scarce resource into a commodity.
And commodities are cheap. That would certainly justify repricing. What's the second theory?
The second is startup competition, or what some analysts are calling the mosquito fleet. Because it's so much easier to build software now, you have these agile, AI-native startups just popping up out of nowhere.
The innovator's dilemma on steroids.
Exactly. These startups don't have 20 years of legacy code to maintain. They don't have massive sales teams to feed. They are lean, they are fast, and they are using AI from the ground up. Investors are terrified that these new players are going to come in and just nibble away at the market share of the giants before the giants can even pivot.
So even though Microsoft and SAP are saying, look at our great numbers today, the market is looking at 2028 or 2030 and asking, will you even be relevant?
The market is discounting the future. It's saying, we don't trust that your cash flows in 5 years will be safe. It's a crisis of confidence in the longevity of the whole SaaS model.
It's amazing how quickly that sentiment shifted. I mean, 2 years ago, SaaS was the safest bet in the world recurring revenue. High margins, sticky customers. Now it looks like a trap. But surely this isn't just about a scary story. Stories move markets. But usually there's some math underneath the panic.
Oh, there is absolutely math involved. And this brings us to the second major factor fueling this crash: valuation. Or, to use the technical term from the reports, the froth.
The froth.
Yeah.
I always visualize a cappuccino when I hear that. But in this case, I'm assuming it means we just paid way too much.
Way too much, yeah. We have to remember, we just came off a massive 3-year boom. This sector was historically expensive. Prices had run up to perfection. And when stocks are priced for perfection, any doubt, even a tiny whisper of doubt, can cause the air to come out of the balloon violently.
Let's put some real numbers on this, because expensive is a relative term. The source material highlights ServiceNow and Palantir specifically. Let's look at ServiceNow first.
Right. ServiceNow, it's an incredible company, best in class. But look at the valuation. Even after falling 50% from its peak in late 2024, and let that sink in, it's half the size it was. It still trades at a price-to-earnings ratio of 70.
Okay, for you, our listener, who doesn't live inside a Bloomberg terminal, let's contextualize a PE of 70. The historical average for the S&P 500 is somewhere around 15 to 20, right?
Correct. A PE of 20 means investors are willing to pay $20 upfront for every $1 of profit the company makes. People are paying $70 for every dollar of profit ServiceNow makes, even after the crash. That implies investors are still banking on massive, uninterrupted growth for years.
And if you introduce the AI disruption fear we just talked about, suddenly paying 70 times earnings feels incredibly risky.
It feels reckless, but if you think 70 is high, look at Palantir. This is the data point that really stood out in the analysis. This is the one that made my jaw hit the floor.
I saw this. I actually double-checked the math because I thought it was a typo in the report.
It's real. Palantir is down nearly 30% from its peak, so it's deep in a bear market, but it trades at a price-to-sales ratio of 99.
Wait, price to sales, not earnings.
Revenue. You are paying nearly $100 for every single dollar of revenue they bring in the door, not profit sales. And if you look at the PE ratio, it's 353.
353. That implies
Right.
that the company needs to grow at 50% a year for a decade to justify that price.
Something like that. It's pricing in world domination. It's
Yeah.
pricing in a future where everything goes perfectly and they capture every dollar of AI spend. And the moment the market gets scared about AI disruption, that number has to come down. That's what we call multiple compression.
Can you explain multiple compression simply? I hear it all the time on financial news, but it feels like jargon that kind of hides a simple truth.
Sure. Imagine you're buying a house that earns rent. If you pay 50 times the annual rent for the house, that's your multiple. If the neighborhood gets a little sketchy or people just get scared, maybe the next buyer is only willing to pay 20 times the rent. The rent didn't change, the house didn't change, but the price of the house collapses because the multiple shrank. That is what is happening to software stocks.
The earnings are fine, the rent is still getting paid, but nobody wants to pay the 353x premium anymore.
Exactly. The balloon is leaking air. And to really drive this home, the source makes a comparison that I think is crucial to understanding the big picture. They contrast these software valuations with the hardware companies, specifically the semiconductor stocks. Nvidia, the poster child for the AI boom. They make the chips that power everything we are talking about. Now, logically, you'd assume Nvidia would be the most expensive stock in the world, right? Everyone needs chips.
It's the engine of the entire economy right now.
But looking at the data, Nvidia trades at a PE of 47.
Okay, so let me get this straight. Palantir is at 353. Nvidia, the company that's actually powering the AI revolution, is at 47.
Yes. And get this. Nvidia just reported revenue growth of 62% in its most recent quarter. That is significantly faster growth than the software companies were worried about. So you have a situation where the hardware makers are cheaper and growing faster than the software makers.
When you frame it like that, the capital flight makes total sense. Why would a fund manager stay in software? You're paying a premium for a slower horse that might get eaten by the track.
Precisely. Money flows to where the risk-reward balance is best. Right now, the semiconductor sector is physically driving the AI boom, while the software sector is in an identity crisis. The market is saying, we know we need chips. We don't know if we'll need as many SaaS subscriptions in 5 years.
It's a sector rotation. Money is leaving the application layer, the stuff we used, and moving to the infrastructure layer, the stuff that runs the AI.
That is the macro trend of January 2026. It's a reallocation of capital based on where the certainty is.
So let's pivot to the so what for our listener. We've painted a pretty bleak picture. Panic, crashing prices, sky-high valuations deflating. If I'm an investor or just someone whose 401k holds these tech funds, is this the end? Is it time to run for the hills and sell everything?
Well, the analysis suggests taking a deep breath. It is notoriously impossible to predict short-term movements. When sentiment takes over, stocks can go lower than you think. Logic just leaves the room. But the analysis also points out that while the fears of disruption are valid long-term, this isn't going to happen next Tuesday.
Right. Fortune 500 companies aren't going to fire ServiceNow and build their own AI CRM overnight. Inertia is a really powerful force.
Exactly. Big companies have contracts. They have data lock-in, compliance issues, security audits. You don't just rip out your ERP system because a chatbot wrote some code. And frankly, the big software giants have the resources to defend themselves. They have billions in cash. They can buy the startups that threaten them, or they can integrate the AI tools themselves.
So the panic might be overdone.
It's likely an overreaction in the short term, driven by that valuation reset. The source suggests a strategy called a flight to quality.
Flight to quality. I always like how that sounds very dignified. What does it actually mean here?
It means you stop chasing the hype and the story stocks, and you start looking for resilient business models with reliable GAAP earnings. You want companies that actually make real profit today, according to standard accounting rules, and have a moat that isn't so easily crossed.
And the source points out a specific name here, one we've already mentioned as a victim of the crash, Microsoft.
Yes. Microsoft is down 23% from its peak last year. That is a huge discount for a company of that quality.
Why Microsoft specifically? Why are they safer than, say, Salesforce in this environment?
Because they play both sides. They have the software Office Copilot, but they also have Azure,
The cloud.
the cloud. Even if companies start building their own AI software, where are they going to run it? They need massive compute power. They need the cloud infrastructure. So whether you buy software from Microsoft or build your own AI, you are very likely paying Microsoft for the infrastructure anyway.
That's a great hedge. They sell the shovels and the gold.
Exactly. The source explicitly calls Microsoft an easy buy right now, despite all the turmoil because of that infrastructure backbone. It's a defensive play.
That's fascinating. It's almost like the market is throwing the baby out with the bathwater. Microsoft is effectively an AI infrastructure company masquerading as a software company, but it's getting hammered with the rest of the sauce group.
And that's often where the opportunity lies for a patient investor. When a whole sector sells off, the good gets sold with the bad. ETFs blindly sell everything. Investors who can distinguish between a company that is actually being disrupted versus a company that is just caught in a narrative shift, those are the ones who tend to win in the long run.
It reminds me of the dot-com crash in a way. Amazon crashed with everything else. It lost 90% of its value. But Amazon was a real business with a real future. Pets.com, not so much.
That is the perfect analogy. We are likely in a phase where the market is trying to sort out the Amazons from the pets.coms of the AI era, and right now it's just punishing everyone until it figures it out.
So if we zoom out, what we're seeing on this Friday in January 2026 isn't necessarily the death of software. It's a reality check.
It's a correction of expectations. We expected software companies to grow infinitely and have infinite pricing power. AI has introduced a variable that challenges that assumption. The price tags, those 300x PE ratios, were simply too high for that level of uncertainty.
And healthy markets need to correct. It's painful if you own the stock, but it's healthy for the long-term structure of the market. It clears out the froth so we can get back to reality.
Exactly. It hurts now, but it sets the stage for a more rational market later on.
Okay, let's wrap this up. We are watching a historic sector rotation. The narrative has shifted from software eats the world to AI eats software. The valuations are sky high, and now gravity is kicking in.
That's the core of it. But remember, the actual earnings reports are still good. The disconnect between the data and the fear is wide right now.
And that disconnect is usually where things get interesting for smart observers. It's a lesson in not just following the narrative blindly. Just because everyone is screaming AI is eating software doesn't mean Microsoft is going out of business tomorrow.
Question the narrative. Look at the earnings. Look at the valuations. Don't just follow the herd.
Before we go, I want to leave you with one final thought to mull over. We've been talking about AI replacing software companies. But think about this. If AI makes it 100 times easier to write software, does that destroy the value of software companies? Or does it just mean that software companies have to evolve into AI companies to survive?
The adapt or die moment.
Exactly. History suggests the best companies always find a way to use the new tool rather than get replaced by it. But the market isn't waiting to find out which ones will make the cut. Something to think about as you watch the tickers scroll by this weekend.
It's going to be an interesting Monday open.
It certainly will. Thanks for diving in with us.
Anytime.